Andrew Holland, CEO of Ambit Investment Advisors, now joins us. Andrew, good morning. I'm looking at the performance of your Ambit Alpha fund, and in the month of August, when the Nifty was down 6.5%, you managed to deliver 0.5% positive returns. So, how did you do that? And secondly, you had 46% cash, unusually high cash levels, and very high short positions as well, 22%. Would you look to change that now that we have seen so much damage to stock prices?
No, not really, Anuj, because we're keeping a very high cash level. Markets at the moment trying to find that bottom is a bit too difficult. So we'll wait to see what comes out from China over the next week or so. And even if we miss the first 2-3% of the market rise, that's okay with us because we're an absolute positive return fund. So I'm not after chasing any relative index. So we can use cash to protect the fund's capital, and that's what we've been doing. It's been a difficult market, as we all know, but protecting capital is first in our mind.
Indeed, that is. The other thing that stands out from this long-short point for me, Andrew, is that you are short on ICICI Bank and Yes Bank, but you're long on HDFC Bank. Any rationale for that?
Yeah, we think, obviously HDFC Bank, we believe is going to be the big winner from, the growth in the India story as we go forward. And obviously, we think its moves in recently to reduce rates for mortgages is going to, again, give it a lead in the marketplace. Whereas we think Yes Bank and ICICI are probably laggards in the banking sector in what we're seeing as more choppy markets, and that's what's proved to be the case.
Okay. Andrew, hi, good to see you in this morning. I was quite intrigued by Lupin as well. What's your rationale for being short on Lupin, and anything besides what you have your top 5 positions in that you like within the pharmaceutical space? There are a lot of bullish calls, say for example, coming in on the likes of Cipla now.
Yeah, I mean, obviously you've got to look at the whole portfolio. So there's obviously some hedging that we do with certain names against maybe other pharmaceutical companies we're holding in the portfolio. So don't just look at it as being a single short there where we're expecting the price to fall. It's a hedge as well against our long-only portfolio. So on the pharma side, again, we kind of like the large cap pharma, but US FDA rules just keep changing, and one night we're okay, the next day you got some ruling. So it's a very, it's not a sector we feel wholly comfortable in, but it's a place to hide in these kind of markets.
Okay, Andrew, when we last met, we were discussing this issue of what China would do next in terms of fiscal support. We've seen quite a bit of monetary steps from China, but do you think that still remains a big risk for the market, or do you think that remains a factor that can lead to the market sentiment changing overall? And would you put your money on Chinese market bottoming out, and in turn that leading to a bit of a relief rally for global equity markets?
You see, Anu, just to explain that, because it's where you come from. So if you go back, say, this time last year when oil prices were around the same level, many people were saying that it was a supply problem, not a demand problem, particularly for commodity prices. We differed in that view and said it's a demand problem and it's coming from China. So what we've really seen in the past month or so is really that complacency about China turning out to somewhat fear about how much the downturn can be. So we think that's played out, or we're there or thereabouts. But what the market wants, in my view, is it wants some fiscal stimulus by China to kind of steady the economy. And I think if we get that, then markets could move higher from here. And I think until we get that, the markets will keep testing the downside until it gets what it wants. And I think we'll see hopefully in the next week or so, with a lot of Chinese data coming out, maybe we'll see that stimulus to help both the Chinese economy, but also for the stock markets. And that would probably form the bottom for me once that announcement's made.
Okay. Andrew, how much of a trigger or maybe a catalyst of returns would be, say, the RBI policy and maybe another 25 basis points in terms of cuts?
So I think the more important factor is China, but let's say China, they do some fiscal stimulus. Then the RBI, if you think about it, even the 75 basis points of cuts we've seen really take us back to where we were before the currency crisis in 2013. So the RBI governor really hasn't done much to propel or help the economy. So I think he could do 50 basis points if he really wants to, but that really depends on him. But I think 50 basis points is doable. I think he can do that. So that would be another catalyst for our market.
Okay, that would be another catalyst. Andrew, let's get back to your portfolio positions. What's your call on auto names? You have long exposure to Maruti Suzuki. Of course, Maruti has started to correct now, but overall, what's your call on the auto space, and would Maruti remain your top bet?
Yes, it does. We still have a view that the dollar will appreciate against the yen, and the yen will probably move towards 140 over the next 6 to 9 months. So obviously that's a good tailwind for Maruti. It's got some new products coming through. So we think the margin improvement for Maruti will continue to play out over the next 1 year. So we like Maruti, and just as in terms of the auto sector, but we're keeping with our auto components companies as part of who supplies India theme that we have. So we'll continue to look at those companies. But in terms of just autos, Maruti is a standout for us. I know you're going to ask me if Tata Motors is going to be on that list at some point. But I think selling into China and the luxury end of the market is going to be very tough for the next 1 year or so. And Tata Motors in India really hasn't done very much. So they're going to suffer on both fronts, I'm afraid.
Okay, that point is taken. You also say that you're beginning to feel a bit more optimistic, and you did discuss the China factor. Which are the stocks that you think could lead the market higher from here? And also, do you still stick to your year-end target of 10,000 on the Nifty, Andrew? Because that now looks quite daunting.
Yeah, everything looks daunting at this point, doesn't it? So we think given on the basis that China does some fiscal stimulus, which we firmly believe will happen, interest rates come down in India, and earnings will start to improve in this quarter, as the raw material prices will have a beneficial impact on margins, and operational gearing kicks in. So I think that lends itself well to a strong kind of year-end rally. So I haven't changed the target of 10,000. I think the sectors that will lead it up will be the banking sector, and I think Reliance and Maruti will be the other two heavyweights. Reliance are heavyweight in the index, which will help that momentum going forward.
Okay. Andrew, just to argue that point on the banking space, would you be worried about, say, what kind of exposure banks, public as well as private, have, say, to the metal space, and hence the susceptibility of the global commodity cycle and what's happening with China, and what then could happen to gross NPLs of banks, capping returns going forward and maybe till the year end?
Yeah, so obviously that's why you're sticking with the private banks rather than the PSU banks. But once the sector gets its momentum, then PSU banks will follow as well. So I think we've known about this problem and for the banking sector, which is why we haven't got overly excited throughout most of this year on the banking sector, and not really chased the rise even a month and a half ago when everyone was talking about interest rates falling because of these problems and because of what's emanating from China. So we think it's being baked into share prices at the moment. That's why I'm saying I'm more optimistic now than I have been since any time of this year, that we're getting towards that kind of end game in terms of the volatility, but we just need China now to do something which would be more on the fiscal stimulus.
Okay, that point is taken, Andrew. It's very rare to see portfolios without IT being part of it, or at least among the top holdings. Of course, I don't have the entire portfolio with me, so you could have stocks like Infosys, TCS. But if you could tell us your view on both Infosys and TCS, are you net long, net short, and what's your call on the IT sector?
Well, I'd say our overall call in the IT sector is long-standing now. We think that decade of growth is over for the sector, and it's going to be more competitive going forward. And you're not going to see the kind of growth that we've seen before. So I don't want to pay 15, 16 times 1 year forward for, single-digit growth. It's just not a value. There's no value in that for me. So again, it's a place to hide, but you hide for a very short period because actually there's no real momentum to move these stocks higher. Emphasis obviously has a change in management and there's some momentum there, but I don't think 1 quarter, as you say, the saying goes, one swallow doesn't make a summer. So let's see what else you can deliver in the next quarter. But it's going to be tough, and I don't want to pay those kind of PEs for a tough environment in the sector, which is going to be hugely competitive.
Okay, just one quick last question from me, Andrew. How worried are you about the rupee depreciation? It's at 2-year lows. Do you think we are well protected on the rupee, or how would you view it? As a positive, because then maybe incrementally exports would pick up for us, or would it be a negative, considering maybe similar to what we saw in 2013 as well?
Let me think about this and try and explain it. When the rupee depreciated so much in the currency turmoil, did we really benefit from higher exports? No, we're not an exporting country. This is a domestic growth story only. So the rupee being stable, I think, has actually reassured investors offshore, not scared them, because we never buy India for a big export, kind of growth potential. So, if I look at the depreciation, I'm hoping now it's really reflecting that we're going to get a 50 basis points rate cut.
Okay, that point is fair, Andrew. Finally then, what's the big risk to this market? You still said that you're hoping for or you're sure of a second half rally, but what is the biggest risk, and what's the risk that maybe this is not just a bull market correction, but maybe a bit of a near-term bear market? What would make you change your view on this market?
There'd have to be some financial problems from China which would be so severe that would affect us all globally. But I really don't see that happening. So, that's not a fear I'm thinking about. But, I suppose if I had to kind of fast forward and say in a year's time, if we were still facing some kind of slowdown globally, is that, obviously people would start to question central banks' policy. And if they do that, then that's when you lose your confidence in the overall economic growth, the financial monetary policies of the countries. But I think we're some way away from that, so hopefully that won't happen. But that would be the biggest fear for me. But I just want to add something on China. It's because whether it's growing at 5, 6, or 6.5%, I don't know, because the figures that it's not transparent. But it is significant growth compared to anywhere else in the world. So I think we're overplaying some of it, which it's sector specific, to be honest, rather than it's globally all sectors. And secondly, if you think about it being the second largest economy in the world, well, so was Japan in the 80s. And whilst Japan's not done anything for the last 20, 30 years, it didn't stop markets and economies growing over that period. So, let's not be too gloomy about this. I know I've been gloomy most of the year, but now I'm a little more optimistic.
Andrew, we can be gloomy considering that we both support Manchester United. But before we let you go, a word on that front. No stimulus for Manchester United, and it doesn't look like we're bottoming out soon.
No, gloom is more like doom or depression for Manchester United at the moment. I fear watching them because I, one, nearly fall asleep watching them, and two, they're just generally so bad that I tend now to think that watching them is more painful than seeing the markets at the moment.
Oh my God, that means you're incrementally definitely positive on the markets, Andrew. Thanks very much for joining in and talking to us this morning. So that's Andrew Holland of Ambit. But for the market, 76.31, just